There is just not enough industrial land, and what it's doing is it's driving rents, obviously driving tenant demand. With that is also the fact that when these facilities are being built, it's costing a fair bit of money to actually get them out of the ground. And so that's just having that on-flow effect to a number of those industrial users.
Welcome everyone to the Burgess Rawson podcast. I'm here with Justin Kramersh and Yosh Mendis. Welcome.
Welcome. We're back again.
Yes, we
Thanks
are.
for having me.
So the world has changed a lot since we sat here last time. We've had 6 weeks of a Trump presidency. We've had tariff fears. We've had a cut in interest rates. Talk to me, how does those change in the economy, Yosh, how are your clients viewing that? And what are they doing in the commercial property space?
Yeah, certainly. I mean, I think across the market at the moment, and I think it's very widely spoken amongst everyone, in the property community around, interest rate cuts. This is the cut everyone's been waiting for. It's come early in the year. I think sentiment in that regard from a property investor perspective is really grown. I think people's mindset was already thinking that this was going to be coming, but for it to come so early in the year, it's given a lot of people a bit of a positive boost. And we're certainly seeing that transpire into inquiry levels, transactions, which we'll speak about shortly. Some of these results that we've achieved on some of these assets recently are a real testament to that positive sentiment that the market's currently seeing.
Yeah. And Justin Kramersh, the industrial expert of the year, congratulations. You've transacted some $40 million worth of industrial property in the last 2 weeks. Tell us what's been driving those purchases and what are you seeing from an industrial point of view?
So the first thing is the tenant covenant. Civil Mart, they're Australia's leading precast concreting brand. They've been recently acquired by CRH, who are the world's biggest building and construction materials company. So, the backing of a Fortune 500 company listed on the London and New York Stock Exchange has just been massive for investors to get comfort around the tenant.
So tell me about these properties. What are they doing there? What do they look like? Why are suddenly passive investors looking at industrial, which traditionally was industrial, people bought industrial? Like, what does this property look like inside? You've been in them. Tell me more.
So very high clearance warehouses. So Pakenham 15.2 metres high. Across the facility, each of them are pretty similar. So you'll see concrete poles, concrete slabs, a lot of sleepers. It was fascinating at the Pakenham site to see what they did. There were these massive concrete spars and they would tile them up and then transport them to homes, drop them in, and you've got a spar. So it's really fascinating.
Wow. And so Civil Mart has sold now to a Fortune 500 company. Who are they? What do they do? And what is their play in Australia?
Yeah, so CRH are now tapping into the Australian market. They've been obviously massive in the North America and Europe space, but now it's about controlling the Australian market. And Civil Mart, they've been around for over 100 years and, they're the biggest players in Australia. So I think it's the opportunity to be here in Australia and, go to bigger and better things.
And I was really interested, Justin, I was actually amazed by the incredibly sharp yield on Pakenham, 3.32%. It was 12.5 million. I understand that there was a land value play in that. So what drove that price and how did you achieve such an incredible yield when industrial yields generally sit at about 5.5%? What happened?
It was an interesting campaign because there were a lot of different factors. The property was, leased 3 years remaining term certain, 4 lots of 10-year options after that, a very high site value of 12.9 million. But the problem...
Wait a second. So they bought it for less than site value?
Yes.
That's incredible.
Yeah.
There's a land tax discount coming to someone there?
Yeah, you'd think so. So, it was a really hard one to price as well because we didn't know how the market would react. What they purchased it on at 12.5 million is 3.3%. So, to sit on that for years to come with only a 20% cap at market review, added, extra challenges. But we had a really big depth of buyers looking at this property, a lot of Sydney-based investors, a high Asian contingent, just given the high underlying land value. So we saw the same thing with the Monash Health property in Dandenong, land-rich site, and, that Asian contingent are just wanting to get their hands on properties, because they're not looking at the next 10, 20 years. They're looking generations ahead. So.
And so, Yosh, you see the same thing in relation to large land value and quality of tenant. I know that you sold the Amazon Last Mile Logistics Centre. What was the driver there?
I think it's the big thing there is covenant. Amazon. It's
Amazon.
It's Amazon. We were the first people to put a publicly marketed Amazon to market. Traditionally these assets are owned by larger institutions. It was the first time that it was open to the broader market, where we had funds management groups, but also a very large depth of private investors looking at that property. And the covenant was everything. And you talk about high underlying land values and covenant. We're talking about Justin Silvermart. You got the best of both worlds with that asset, and it was reflective in that 3% yield. We've got something like with West Gosford, which was a very expensive facility to build, so the depreciation for that asset was huge. And the covenant, you can't get much stronger than a top five business in Australia, in globally.
And that's the theme we're seeing, isn't it? Where the replacement value of these things, because of cost of goods, cost of concrete, has gone up so much that often you can't replace this. I mean, you're talking about Silvermart selling for less than its land tax assessment. You're talking about the quality of the Amazon facility and the way it's been built. Investors I think you're looking at these things because they can't build them.
That's it. And a lot of the product that we're seeing in that industrial space at the moment is people are buying these assets at below replacement costs. The land scarcity for industrial land across Australia and every Australian market at the moment, really, particularly broadly around that eastern seaboard at the moment, is so tight. There's just not enough industrial land, and what it's doing is it's driving rents, obviously driving tenant demand. With that is also the fact that when these facilities are being built, it's costing a fair bit of money to actually get them out of the ground.
We've had a 19% increase in regional. We've had 11% increase in metro. When does this end? What do you see for industrial rents across Australia?
I think they're going to continue to soar. There's just such a shortage of available land. We saw that with Audi. They've just now leased one in Western Sydney by the airport, which took them 2 years to find. Similarly, the Reject Shop in Sydney, they're opted to leave the location because they can't keep up with the rents. We're going to see a lot of that and increase in rents moving forward.
And I think also the just-in-time versus just-in-case post-COVID has changed the industrial landscape forever. In the early 2000s, industrial was the last to come up and the first to come down. That's changed completely. COVID has materially shifted this entire industry, and I think that's potentially why our sort of investors, passive investors, are looking at this property. The Silvermart, obviously a great tenant, Justin, now bought out by a Fortune 500 company. You're bringing 2 more Silvermarts to market. Tell me about those.
Yeah, so we've just brought Wodonga to the market, which is massive land holding, 69,000 square metres, right by the Hume Highway.
Wait a second, how big?
69,000 square metres. So
near the Hume Highway.
Yeah,
that's amazing.
So,
that's amazing.
Yeah, incredible site.
Do they cover the whole site? Is that part of the site? What does that look like? Walk me through what that looks like.
So it's a triangular shaped site. In fact, they need more room. They're leasing some space from VicTrack as well. So you see that with a lot of the Silvermart sites, massive facilities, but they're also leasing, properties next door and adjoining properties. So, there's a lot of growth happening in Albury, Wodonga, and a lot funded by the state government. So Silvermart here will play a crucial role in being able to, support all these infrastructure projects happening.
And Yosh, you've got some really exciting properties coming. I mean, a couple of years ago now, we sold the PFD portfolio. PFD to me is a fascinating tenant, majority owned by Woolworths, but you're going to probably tell me that's changing shortly. We did a portfolio where I think we sold 13 of them in some 26 days. You've managed to get your hands on 2 more. Tell me about those.
Yeah, so these ones are really exciting. It's so we're selling the PFD in Geebung in Metro Brisbane.
Where's Geebung?
Metro Brisbane,
Right.
a couple of k's out of the CBD. It's a beautiful 5,000 square metre land holding, pure metropolitan Brisbane land holding. What I like about this facility is PFD have signed a 20-year lease, which expires in 2041. They've just undergone a multi-million-dollar upgrade on the facility. It is amazing. Like, it is a seriously extensive expansion, and hence why they've signed some longer tenure.
And obviously this is cold storage as well. So we're talking a very sticky tenant, a very extensive fit out
Absolutely.
that cannot be easily relocated. I mean, not to mention 5,000 square metres in the middle of Brisbane, but talk to me about why investors are so passionate about these sticky fit outs.
Yeah, absolutely. So similar to other asset classes, the industrial facilities that we're looking at now, particularly when you look at this cold storage, as you said, they're really expensive fit outs. This purpose-built facility, it seriously takes a lot of money to actually get up and running. This one in Geebung in particular is used for seafood processing and distribution and storage. So you can imagine the type of goods that they're dealing with. It's very, very important for them to be housing in, clinical type warehousing facilities. And this is one of the best. Like, it is it's very clean. The new expansion looks absolutely beautiful. But it gives an investor an ability to buy an asset, have some really high kind of flexibility and demand fundamentals, in the sense that they've got 17 years of passive income, but they have an opportunity to either hold that asset long term, they can exit halfway through the term. There's a lot of and the covenant strength with PFD, who have now acquired the remaining portion of that acquisition of PFDs.
So Woolworths is now owning PFD.
They fully own
right.
PFD.
So you're basically, a tenant is akin to a supermarket. It's the best tenants in Australia, being Woolworths.
Correct, and at a price point that private investors love.
What's that price point? Talk to me about that.
Yep. So across the board, you're looking in that circa 5 to 7 million price points for these assets. That's across the ones that we're doing, say in Devonport and G-Bunk. Devonport's another interesting one. 19,000 square metres of land in Devonport.
Wow.
3,000 metre building, only 16% site coverage. So you've got a long-term lease to PFD on that site as well, but in the future, there could be more expansive uses for that land. You're getting 19,000 square metres of land. You don't have to do anything with it today, but the avenues to have that readaptability is really beautiful. These are really assets that we cherish, we really enjoy selling, and certainly we're really excited to see how they perform on auction day. Certainly, I think, going back to your point before around covenants and the rise of industrial, I think we're certainly seeing this demand from passive investors to buy this asset class. They've got good high underlying land values, large land holdings, very expensive replacement costs, very readaptable buildings. The readaptability and the demand for industrial tenants. If a tenant decides that they wanted to move, you're going to be filling that tenancy up very quickly. So that security and underlying real estate fundamental is super important. As we know when we're talking to investors, for a lot of them, they just want something that's hassle-free. And if they ever do have a hassle, it's an easy fix.
Yeah.
And industrial property is giving that.
Yeah, exactly. And with the Wodonga lease, how long have you got on that, Justin?
So 10 years to 2031 with 4 10-year options after that.
So 10 years, 17 years. What's Devonport got?
Devonport's 2031.
Wow.
Yeah.
So really, really long-term leases, which I know that our investors absolutely favour. And whenever we bring this stuff to market, they're looking for that longevity and locked-in rent increases as well.
Yeah. So with the Civil Mart Wodonga, it's the greater of 3% in CPI, which is fantastic, and the tenant pays all outgoings, including land tax. So
wow. Yeah. And you've got land tax on the PFDs, Yosh?
All recoverable. Yeah.
Fantastic.
So no leakage.
That's what I want to hear.
Seriously. And that's the thing. People can track their cash flow really strongly, and particularly when you're talking about the Pakenhams of the world and things, and G-Bunks of the world, where the underlying land content is so strong, that land tax recovery is just so important.
And it's a protective mechanism, because what we have seen is that successive governments around Australia, and no less, Victoria is probably the worst at this, are seeking to recover their COVID spend through land tax and through taxes that hit the least number of voters. If I'm going to be really controversial and say it out loud, they're looking to hit landlords because they're the least number of voters. And so leases which have longevity but also protectionism against that sort of movement by government, I think, are even more highly sought by our passive investors. Wouldn't you agree, Justin?
100%. Yeah.
And so what kind of feedback are your investors giving you when they're looking at this? Who's buying this property? What are they saying to you as their reasons behind buying this property? What's the reason behind buying a property for 3.3%?
So looking at Pakenham, that was bought by a Sydney-based private investor, obviously attracted to the tenant covenant and the large land holding and the underlying land value. Having said that, it was a 3-year whale, same as Corio. We sold that at a record yield ever for an industrial property in Corio at 5.37%.
Tell me about that one. How long was the lease? How big? What are we talking?
Same lease as Pakenham, so 3 years term certain, 4 10-year options after that, non-recoverability of land tax. So that was paid by the landlord in this instance, because their predominant use on site was selling retail to the public. This site in Corio, located on Hills Road, it was in the 500-hectare Geelong Ring Road employment precinct, and one of the largest designated industrial growth areas. The the great thing about this site, it was the connectivity via road, air, rail and sea networks, which would always demand a lot of interest in years to come.
And I think Geelong as a whole area is absolutely booming as the second city to Melbourne, isn't it?
Yeah.
I mean, the amount of employment and businesses that are moving there for cheaper rents, greater accessibility. You've got you've got Avalon Airport. It's a real option for businesses now.
No doubt. And, looking at the zoning, Pakenham was Industrial 1, this was Industrial 2, so we thought there would have to be a softening, and also the fact that it's more regionally located. Having said that, Geelong is just such a popular area, and that's where most investors are looking towards, as it's, the second fastest growing city.
But I suppose it doesn't matter when you're buying a lease with such a sticky tenant, with such capital intensive works on the site, that it's not necessarily, we're not seeing developers buy these, are we?
Not always. I mean, this was a passive investor from Sydney again, but the site across the road from this sold at a land rate of 230 a square metre. Typically, at the moment, what we're seeing is there's so much demand for available sites ready to construct, and this site was sold in Corio, sold at a land rate of 300 a square metre.
Wow, that was a record for the whole area.
It was a record yield, not record land rate. There was one on O'Brien's Road, which happened middle of last year, which was 420 a square metre, which was just a knockout result.
And Yosh, on the way over here, it was so great to have you down from Sydney. Talk to me about this owner-occupier market that you're seeing in industrial. I think our listeners want to hear more.
Yeah, so it's interesting. I mean, you and I were talking about this before, and it's one of the things I really love about industrial. There's just so much flexibility and readaptability with these assets. Obviously, we spoke before about the releasability of these assets, readaptability for other uses, but the owner-occupier market for industrial is so strong at the moment. And for all the reasons we spoke about, low supply of new product, high underlying land costs, people preferring to buy a built product as opposed to waiting for a new developed product.
Well, it's too costly to build
It's
at
too
the moment.
costly. And what's happening with that is it's driving that owner-occupier pricing, and it's driving the building rates and land rates for these assets. But for an investor, when they're buying these assets as well, obviously a lot of them are buying them from a cash flow perspective and an annuity point of view. But again, they get this underlying real estate security that some other assets don't offer. Where
It's a level of liquidity, isn't it, really?
It is.
So, if you did need to divest that property, I was talking to a client the other day about a supermarket. I said, if you need to divest it, you're going to divest it very, very quickly. So that secondary, different type of market to what we deal with, that owner-occupier market,
Yes.
adds a level of security and liquidity to the asset,
Yes.
even though you're spending, $12.5 million.
Absolutely, and in some cases, it's even better for them to wait for the annuity to finish, have the tenant leave, and then they actually sell it as an occupier opportunity. And there's actually in some cases, there's actually upside there. So it is one of those asset classes that only exhibits that type of fundamental. There are some other asset classes that exhibit it when it has a higher fit out costs and things like that. But industrial as a whole is probably one of the major asset sectors that is very rich in owner occupiers and tenants.
Well, if you compare it to something like a fast food, generally, I mean, of your best tenants, who's going to drive your yield the sharpest, they don't own their sites.
Correct.
So there's an example where you've got a great industry, but they don't want to own their sites. Whereas industrial, there is a whole nother market of owner-occupier that drives price, drives market depth.
Yep.
Which is great for your purchasers when they're looking at these assets and looking at their overall portfolio. I know that when I've been speaking to my clients, they're saying, okay, well, Ingrid, I've got a supermarket, I've got a fast food, I've got a childcare. I actually want to balance it out. And the industrial piece is offering them land size, which is quite different to those other assets.
Yes.
So I think, 69,000 square metres in Wodonga.
It's massive.
How do you go wrong with that?
Yes.
We might need to say that about 3 more times before I fully how big this thing is.
It's a chunky side, and there's a lot of infrastructure happening there. So, it's well needed.
It's completely right though. Like the diversification is huge at the moment. Even some of the industrial assets that we've sold, and we were talking about this before, right? Even looking at even the buyer who bought Amazon, and even the underbidders on Amazon, they had bought many other asset classes through us.
Yes.
They'd either had fast food or fuel or childcare, and this was a way of diversifying because they're getting the covenant strength of like your Coles and your Woolworths of the world, but by being able to diversify their asset class entirely within their portfolio.
And what I'm also finding really interesting is vendors choosing Burgess Rawson because traditionally we're not industrial agents, we're not sheddies as they would normally call them, but I mean, the feedback that I've been hearing, and I would love to hear what you're getting, is that they're actually seeking out that private investor database, and they're seeking out the passive investment as a lease, and they're looking at their product very differently. What kind of feedback are you getting from vendors? Why are they choosing you, Justin, the new king of industrial? Why are they choosing you?
Well, it's funny. It all started in Torrington, just outside of Toowoomba, a little site, and I was actually selling a childcare site for the same owner, and he flagged this one with me and, asked, is this something that would, be suitable to the Burgess Rawson portfolio? And just given the price point it was, we took it to market. We were hoping to get, 7%, and it ended up trading at 6.5%. So I think by way of that transaction, it gave him a bit more confidence in Burgess Rawson and, going with us for industrial assets, which then brought us to the Pakenham result, which was obviously a knockout. And, days later, we ended up transacting the Corio site. So I think things have just taken off, and it's not necessarily about what we specialise in as far as the asset. It's, knowing our pool of buyers who are just looking for passive investments, large sites, and moving away from their typical, asset classes like fast food and servos like we spoke about.
Yeah. And I think the auction portfolio itself, brings us the most up-to-date current list of investors, because obviously we've seen how they interact with the portfolio auction. We know their price point, what they're looking for, how they're looking for it. And so that means, I suppose, our access to the market depth and the most up-to-date market depth is at our fingertips, literally. Mm-hmm. And vendors are seeking that. In this market, which has been quite a difficult market, especially while we were waiting for this interest rate cut, it's the agent who brings the most number of buyers, which is how the market's behaving at the moment, isn't it?
Yeah, absolutely. And reiterating some of Justin's comments, but certainly around, that different type of buyer profile that's looking for these investments, the passive investment opportunities where, they're buying the security of that covenant, which has always been a scenario that's always been looking at different asset classes, but in that, shed land and, things like that, it's, there are here's what the owner occupier rates are, here's what, yields are for the area. But they're not thinking about, this is the yield that someone will pay for Amazon covenant, or Woolworths covenant, because we've sold them one in New South Wales or Victoria and Queensland. They value that covenant irrespective of where the location is.
Mm-hmm. And we've seen that even we've brought the same mentality to fast food, medical, convenience retail, whereby we bring buyers to the convenience retail asset. Now, that asset might be in WA, New South Wales, Victoria, but our buyer is interested in the convenience retail asset.
Yes.
And I think that's a really key point of difference. And that's where, the civil marts, for example, you can bring them as a portfolio, you can speak to a wider audience on them. And I think your buyer came out of Queensland on one of them, and another one came out of Sydney.
Yeah. So for the three Queensland assets are all bought by Brisbane-based investors, and the Victorian ones, what we're seeing, and it's not just industrial, a lot of the childcare assets we're selling, it's a Sydney-based private investor. They're looking for better bang for buck.
Yes.
The capital underlying land value in Sydney is a lot higher, but they're looking for more opportunity, and that's what we're seeing at the moment.
Yeah. And I've certainly been hearing that a lot with Melbourne and the slower house price growth in Melbourne. It's actually a bargain because the industry is here, the economy is here, the people are here, but you are buying at a substantially different rate to proper Sydney proper or to even Brisbane Metro as well.
Yeah, 100%. And that crossflow of investors is just happening at all-time highs at the moment. Like Amazon's a great example. The buyer of that is based in Melbourne, and many of the underbidders were based in Sydney and Melbourne. Really, that's where a lot of that capital came from. It's like you said, people are focusing on the asset class and covenant, and we're cross-pollinating amongst our states so much at the moment. Probably more than we had previously, just in that short period of time with interest rates. We're talking about WA properties as well. Like the last convenience retails we've just done in WA were sold to investors in Sydney, just as a chase to get a little bit more yield, but the exact same tenant covenants.
Well, that's the thing about WA. It's a softer yield.
Yes.
And so if you are chasing that return and you're looking for that to stack up, WA gives you a good option. The other one obviously is South Australia with no stamp duty on most commercial property, some are excluded. That in the overall calculation by a purchaser, those properties are stacking up that bit better. Yeah. And then add to that things like everyone looking at what the lease covenant is, triple net, double net, what protections do you have under the lease from government legislated increases? That's also playing into it. So I know with the clients that I'm consulting with, we're looking at that level before we're looking at location. Location is almost coming further down. We're looking more at that calculation and how that lease returns and performs.
Yep.
And then it's location.
Yep. Yeah, absolutely. And even, some people forget, irrespective of the yield that you're buying it at today, you're taking all this income over the time. If you've got a 20-year lease, if you sell at year 10, your rent is significantly different from day 1 to year 10. The capital growth that you have in that investment and all the income that you take through that period, the return on investment over that time, if you do exit the asset, is phenomenal.
Yeah, and we've seen continued compression of yields. Justin, what do you see happening with yields post interest rate rise? What are you hearing in the market around yields and where they're sitting at the moment?
I think investors have looked at opportunities now, just given that we've had 12 interest rate rises and now we've had one come down. Buyers are looking at opportunity to get in early before they continue to come down. I think now there's the most certainty in the market. Speaking to investors, we're all on the same page, where I feel 12, 18 months ago, there was just so much uncertainty. No one knew. It made it harder for us to be able to, communicate to owners and buyers because, the reality is we didn't know what was going to happen. But I think everyone's on the same page now, which is really great. And I think, for quality essential service assets, we're going to start to see, continued compression of yields. But at the same time, those assets that won't trade if we, have a pandemic and a lockdown, those are the ones that are really struggling at the moment. And to get investors on board to, pay a similar yield, it's just not happening. The other thing I've noticed is over the last 12 months, buyers have become a lot smarter. They're looking, scrutinising every part of the property, the leases. So like we spoke about before, it's not all about the location. It's about all those other factors, the lease, the tenant covenant, as well.
And that means that the way that you bring property to market and what you need to know about a property becomes paramount. And your role as an agent becomes even more important because they want to know so much more information and they want it at their fingertips. So I know that, we've been working a lot on how we deliver that information to buyers because they want everything. They want it at their fingertips. They want it easy to interact with. And that changes the whole buyer experience. As soon as I find that, as soon as they hit a roadblock where they can't get the lease or they can't get access to the data room, they're not interested. They're on the next thing because there are other assets out there. Talking about other assets, next auction. I'm looking at the list here and I am excited. I'm really excited.
Me too.
Wow. We've got some 6 or 7 childcares. We've got some 5 convenience fuel. We've got some accommodation assets. We've got assets all around Australia, including obviously Tasmania, South Australia. I'm going to start with, I'm going to start actually, Yosh, with a stat I heard this morning, which is EVs have dropped to some 6% of sales. Petrol cars or hybrid cars have to overtake, and we're seeing a drop in the second-hand market of Teslas. So, the age-old thing of there's no such thing as fuel stations in the future, which we've always laughed at. Yosh, we're bringing 4 incredible assets to market. Yeah. Talk to me about why you love them. What are they? What don't you like about them? Which one am I buying?
Yeah, it's funny you talk about this EV thing. When we did our convenience retail podcast, in speaking between you, me, and Jamie, when we were talking about this EV story, it's amazing where all we just needed was a little bit of time for everyone to feel what that story was going to be like, and now it's coming through. It's not all what it's cracked up to be. This EV story, and certainly, the hunger that we're seeing from fuel tenants to still get new sites. It obviously it's not deterring them from expanding their networks.
Well, every month we sell more fuel cars or hybrid cars than we do electric, obviously. I read today that the 6th highest selling ute was the Shark 6 by BYD, which is a hybrid. Yep. They all need fuel. Yeah. They all need convenience. And these sites are located usually on corners in key locations, but more importantly is the covenant. So talk to me about the ones that we're bringing to market. So we've got a Caltex and United Petroleum, both in Queensland. Yep. And then we've got some in Sydney as well, Yosh, which I think with you are Caltex as well. Yep. Talk to me about what are your favourites? Talk about the covenants.
Okay, so in Sydney we've got the EG at North Narrabeen, Sydney Metro Convenience Retail Asset. Yeah, I've said it. Yeah, that's. I mean,
What more do you want?
Yeah, I mean,
Sydney.
it's really the boys' job's easy in that regard. But no, it's a beautiful asset. It's North Narrabeen, all the beaches, Sydney Metro, really, really strong location on Pittwater Road. It's leased to EG, so obviously global tenant covenant. They got 6,600 sites globally. Performs exceptionally well. This site is what I like about it is to go buy that land and build that asset today. It's like the
You've
cost.
got Buckley's.
Yeah,
You won't get the permits.
The permits, access, high underlying land costs, construction costs. You're just buying good, genuine real estate.
Yeah.
So I really like that asset. It's an asset that we're certainly excited to be marketing at the moment. The other asset we're doing is the Metro Petroleum Sefton.
Mm-hmm.
It's a different.
Where is Sefton?
Okay, Sefton's inner West Sydney. The interesting part about Sefton is the lease term is reasonably short. You've got about 3 years remaining lease and a 5-year option. But you've got a high density residential land zoning. So in theory, at the moment, for someone who buys it, it's a good annuity stream and enjoy the cash flow. But there is from a long term perspective, there is readaptable use on that land.
Right.
So it's one of those things that if I was an investor, you're looking at we're talking about location, land, and tenant covenant. You get a mix of all of it with this one. You do get the house next door as well as part of the lot. So there is a significant land holding there to be kind of looking at generationally. Sorry, I should say, for potential readaptive use for maybe residential in the future.
And Justin, what I'm seeing in the Melbourne auction is a really, really strong medical offering. Tell me about which of the medicals your favourite is and what's the underlying stuff. I mean, with the dentists, for example, we know that sticky fit out. We know that, dentists always sell incredibly well. We've got 2 dental ones coming to auction. What do you think about those? What are you looking for when you're looking at those dentists as an offering?
We've got Templestowe Lower and Epping, very popular metro locations. We've done a lot of transactions out in that Epping way and, achieve yields between 5 to 5.5%. But I love the dental space. The fit outs are so expensive, so relocating for a tenant just would not make sense. These are, newer sites, long leases, good fixed increases, and most of our investors are typically looking to set and forget properties, and this is one of them.
And also we've seen a revisit by the government into Medicare and support of dental, which wasn't there previously. So it was an expensive item, but now there is actually some true government support. Dental One, I think, as well as a brand, they've created a single look brand, even though with different franchisees and different dentists on site. So your tenants there on site in the premises every day, but at the same time, you've got the benefit of this huge network of dental offering, which people trust and they love the brand, don't they? 100%.
That's what people turn to. If you're getting anything medical related, you want to know who you're going to and seeing the professionals are going to look after you, and you've got that trust.
Yeah, and they're not at massive price points. So both of these assets sit under the $4.5 million mark. Certainly they're accessible to the average buyer, but also with that 10-year lease, it's a great investment to look at.
Yeah, when you're looking between $3 to $4 million, you got Templestowe Lower and Manningham Road. I'd be snatching that in a heartbeat.
Yeah, it's actually right near where I live, and we've also got the Metrolink happening there as well. So the connectivity that is coming to that area, and I think also the influx of people that are going to come to that area, as well as the council has had a really open look at high density and multi-site dwellings there as well. So they're very open to development, which has been good. And you're also feeding off the massive Doncaster growth.
No doubt, yep. Quality investment, definitely have a look at it. If you haven't got your magazines or you don't get them, reach out to one of the agents and be up to date with what's coming up in our portfolio campaign and the ones to come.
And I also know we've got quite a few childcares coming to market. I know you've got a story house, early learning, Justin, but overall childcares are always the darling of the market. Government funded for the majority of your rent, really, really high quality tenants, great sites. Tell me about the story house. What is to like about that property?
The location, in the city of Casey, one of the fastest growing municipalities in Victoria. So, but also the tenant covenant story house. They've got 50 locations across the eastern seaboard. This tenant's trading at high occupancy. Like when you walk through that centre, you just see hats and drink bottles everywhere, a lot of kids, which is always a good sign when marketing a property for sale. This one's licensed for 107 places. And, with the short-term lease, there is opportunity with the market review coming up. And, one to look out for. And it's a high-yielding one too at 7%.
Oh, fantastic. And what else in the Victorian auction are you going to be drawing our attention to, Justin? What else should we be looking at? I mean, obviously, from a childcare point of view, we've also got Malden, which is a good start early learning education. I'm excited about that because of the price point. In fact, the price point was something that was really drawing my attention to this next auction. We've got stuff from just under $1 million to just over 18 million. And I think that means that there's something for everyone. And then we basically have an industry for everyone. We've got childcare, we've got industrial, we've got fast food, we've got medical. There's a really great theme. And then also I'm seeing is an accommodation theme, which is the property in Tasmania and also in Morwell. How are they being sought by investors? Like, are investors talking to you about accommodation assets? Is that something that's an emerging space?
We haven't sold a lot of it, so there's not enough data out there. We did sell one in Belmont a couple of years ago, which was a residential services accommodation. The depth of buyers, it wasn't as large as what we've seen for our typical essential service assets, but definitely, there is opportunity. You might get a better yield on it, and it's just something different. And a lot of people who are looking at the assets in that space know about it and, are on the hunt for more of those.
Yeah. And so to close it, I suppose, for anyone who's just stumbled on this podcast right now and they're going, how do I find out more about this incredible list of properties? Yosh, what do they need to do? How do they buy one of these properties?
Yeah, so a few things. So obviously you can go to our Burgess Rawson website. We make it really easy for everyone. We've got a table view of all the portfolio and all the investment product. You can actually categorise asset classes that may suit your mandate more than others, and you can actually call your investment specialist from there. Any of the Burgess Rawson specialists you can call and say, we can have a look at a couple of properties. We obviously work as a team business to make sure that we can get those investment properties through to you. And then we have 3 auction days: Sydney, Melbourne, and Brisbane. So come along. We encourage investors to come, whether they're buying or not. Obviously, we're a litmus test of the market. So if you don't know where a property trades, come to one or two of the auctions, and you'll understand what a Sydney service station is, or what a Melbourne childcare goes for, or what a Brisbane industrial asset goes for. So certainly, more the merrier, and we certainly welcome everyone with open arms.
So Justin, we have a raft of information coming out of Burgess Rawson. We've got infographics, we've got industry reports, we've got our portfolio magazine. How do people get this stuff? How do they access all of this information?
Firstly, through our Burgess Rawson website, which is very well viewed amongst the investor market. Reach out directly to any sales agent. If you're chatting to them, ask them for a copy, or contact our marketing team directly.
Great. And I think our next report coming out is pubs and hotels, which will be really interesting. Our industrial report is out right now. So all things industrial, all things driving the industrial market, that's available to be downloaded or mailed to you now as well. Well, thank you so much for joining me today. It's been an absolute blast. I've enjoyed so much speaking to Yosh Mendis, our head of agency in Sydney, and Justin Kramersh, our industrial specialist expert of Australia now. Congratulations on the outcomes you've achieved for your vendor. You should be incredibly proud, and I can't wait to see what you've got next in store.
Thank you so much, and appreciate you having me on the podcast today.
Thank you.
It's good to catch up. I'm looking forward to 2025. It's going to be a big one.
Let's bring it on.